Buying the jet is not the deduction. Basis, placed in service, bonus depreciation, and the 50% bonus use trap. Hello, this is Forrest Owens. I'm an aviation lawyer, a private pilot, and an FAA licensed airframe and power plant mechanic. Let's begin with the first tax mistake people make with large turbine aircraft, because it is also the most expensive. They often think buying the airplane creates the deduction. It does not. The tax result turns on basis, business purpose, placed in service timing, and documented use after closing. For large turbine aircraft, that distinction matters enormously because the numbers are large enough to make timing errors painful. The buyer may sign for a Gulfstream, Global, Falcon, or Challenger in December and assume the aircraft is immediately depreciable. But for federal income tax purposes, depreciation begins when the aircraft is placed in service for its assigned business function. That is a legal standard, not a celebratory one. Here is what you should keep in mind. The wire transfer closes the deal, but it does not necessarily start the depreciation clock. The placed in service problem is not academic. In Brown versus Commissioner, the taxpayer purchased a Bombardier Challenger near year end and wanted bonus depreciation that year. But the aircraft was still undergoing modifications the taxpayer himself characterized as necessary for its intended business mission, including interior and equipment work. The tax court held that the aircraft was not placed in service in that earlier year. The case is a warning to every large cabin buyer trying to race the calendar. Delivery, title, and even some actual flying does not always mean the aircraft is ready and available for its specifically assigned function. The next issue is listed property. Under Section 280F or 280F, aircraft used as a means of transportation are listed property. That means the taxpayer does not get the same forgiveness that sometimes exists with ordinary equipment. The substantiation rules are tighter. The business use percentages matter more. And accelerated methods can be lost if qualified business use falls too low. For large turbine aircraft, the 50% threshold is a critical planning point. If the aircraft does not satisfy the requirement level of qualified business use, accelerated depreciation can be limited, and prior depreciation may be subject to recapture. In other words, the tax problem may not appear only in year one. It can arrive later, after the owner has already celebrated the deduction. That is exactly why flight log integrity matters. In Linsford versus Commissioner, the taxpayer claimed airplane deductions in prior year 26 USC Section 179 benefits, but they could not substantiate the business use the way the code requires. The result included disallowance and Section 280F recapture. Linsford involves a smaller aircraft, but the principle becomes more severe, not less severe, when the asset is a multi-million-dollar turbine aircraft. Owners also need to understand what current bonus depreciation planning really means. Current IRS guidance states that eligible depreciable property acquired after January 19, 2025 may qualify for permanent 100% additional first-year depreciation, while taxpayers in the first year ending after that date may elect 40% instead, or 60% for certain aircraft with longer production periods. That is powerful planning territory, but only for property that actually qualifies. The existence of favorable bonus depreciation does not relax the placed in service test, the listed property rules, or the need to prove business use. You should keep in mind that the schedule of depreciation does change frequently and should be checked with specificity for each aircraft. There are many sophisticated buyers that go wrong here. They spend all of their pre closing energy on purchase price, sales tax, and registration, but too little on the federal income tax architecture that has to survive an IRS exam. Who is the taxpayer? What is the aircraft's assigned business use? When was it truly ready for that mission? What documents prove that? How will personal, entertainment, deadhead, charter, and maintenance flights be classified? If those questions are answered late, the tax return is often doing cleanup instead of reporting a well-built plan. There is another large turbine wrinkle here. Basis is not just the invoice price. Owners need to sort capitalized acquisition costs, completion center work, aviation upgrades, imported equipment, and later modifications carefully. A jet can be delivered in one configuration, modified immediately, and used under one operational model while being reported under another. That is fertile ground for error if accounting, legal, and flight operations are not aligned. So, what is the practical strategy? First, decide before closing which entity will own and depreciate the aircraft and whether the entity has the right economic activity to support the position. Economic activity is something to carefully consider. Second, define the aircraft's specific business function in writing. Third, document delivery, readiness, crew status, required modifications, and initial mission availability. Fourth, build a flight record system that captures not only dates and passengers, but also the tax characterizations of each leg. And fifth, stress test the qualified business use percentage before the return is filed, not after an audit notice arrives. Keep this in mind. In aircraft tax planning, the most expensive word is not purchase, it is proof. In short, the first common IRS issue with large turbine aircraft is that owners often confuse acquisition with qualification. But the tax law asks harder questions. When was the aircraft placed in service? Was it used in a sufficiently documented business manner? Can the taxpayer prove without restructuring the story later? Planning is key. And here is the takeaway, something to remember. On a large turbine aircraft, the deduction usually belongs to the owner who planned the records before that first flight. Personal use, entertainment, and why standard industry fare level does not save the deduction. Now let's turn to the second major IRS issue, and this is why many large turbine owners become unintentionally optimistic. Personal use of aircraft is not cured merely because the company owns the aircraft and the trip happens to involve executives. The tax system separates at least three questions that owners often collapse into one. First, is the flight business, personal, commuting, or entertainment? Second, must value be included in someone's income as a fringe benefit? Third, even if there are income exclusions or inclusions, how much of the aircraft expense remains deductible to the company? Those are different questions, governed by different rules, and large turbine aircraft create mismatches between them. Remember this, SIFL, or Standard Income Fare Level, may value the ride, but it does not automatically rescue the write-off. Treasury Regulation Section 1.61-21G provides non-commercial flight valuation formula, commonly known as SIFL. The value assigned under SIFL can be much lower than the actual hourly cost operating a large turbine jet. That is why owners and executives sometimes feel comfortable once they hear that personal flights are being picked up as income. But compensation inclusion and expense deductibility are not mirror images. Section 274 and Treasury Regulation Section 1.274-10 are where the trap becomes real. Current law disallows deductions for entertainment expenses and for facilities used in connection with entertainment, including aircraft, except to the extent a statutory exemption applies. The IRS's own guidance tells examiners to focus on direct and indirect aircraft cost, including depreciation, pilot wages, interest, insurance, and hangar fees, and then allocate those costs using one of the permitted methods. That means a large turbine owner cannot simply say, the CEO had income, so we're done. The company still has to determine whether the flight was business or entertainment, whether guests were on board, whether a spouse accompanied the executive, whether the travel had a bona fide business purpose, and whether the company is entitled to a deduction exemption. The regulations also require consistency in the chosen allocation method for that year. A real-world litigated example helps explain the danger. In Sutherland Lumber-Southwest versus Commissioner, the company allowed officers to use a corporate jet for personal vacation flights and included the value of those flights in income under the SIFL rules. The taxpayer won under the law then in effect, and the Eighth Circuit allowed the company to deduct its costs. But that case is memorable precisely because owners still cite to it too casually. Congress later tightened the law, and today, post-Tax Cut and Jobs Act 2017 landscape is materially less forgiving for entertainment use of business aircraft. So, while Sutherland remains important, but mainly as a warning about chronology, a case may be famous in aircraft tax planning and still dangerous if someone quotes its result without quoting its date. The IRS has made unmistakably clear that this area is an active compliance target. In February of 2024, the service announced plans to begin dozens of audits involving business aircraft and personal use. That announcement matters because it identifies the exact place where sophisticated taxpayers most often get careless, classifying allocation and substantiation of use. What does this look like in the real world? An executive takes the family to a sporting event on the company's large cabin aircraft. The company imputes SIFL income to the executive and assumes the matter is closed. But if the trip is entertainment, the company may still face deduction disallowance. If guests travel, the calculation gets harder. If a spouse joins without a bona fide business purpose, Section 274M3 can become relevant. If the passenger manifest is incomplete or the stated business purpose is vague, the audit becomes a credibility test. That is why the passenger list is not a hospitality detail, it is a tax document. On a large turbine aircraft, every seat can change the answer. The practical strategy here is disciplined classification. Every leg should identify passengers, the role of each passenger, the purpose of the trip, and whether the purpose is business or entertainment, whether the flight is commuting, whether any reimbursement was made, and whether any amount was included in compensation. The process should happen close to time to the flight. Memory is not a tax control. Owners should also align payroll, tax, and flight operations. The flight department may know who was on the airplane. Payroll may know what was included in wages. Tax may know which allocation method was used. And the IRS will want to know whether all three systems tell the same story. When they do not, the return begins to look like it was engineered rather than recorded. In short, the common IRS issue with large turbine aircraft is the false belief that personal use is manageable so long as someone pays or picks up civil income. That is incomplete. The real issue is interplay between valuation, deduction disallowance, and proof. Remember this. Take this away. Keep this in mind. On a large turbine aircraft, the tax problem usually is not that the flight was personal. It is that the owner misclassified what the personal flight meant. The quiet tax trap, federal excise tax, leases, management structures, and audit readiness. Finally, let's discuss the third major IRS issue, because this is one that often surprises otherwise sophisticated owners. Not all aircraft tax problems are income tax problems. Some are federal excise tax problems, and those problems often arise from management, leasing, reimbursement, and transportation structures, but without enough attention to how the flights are actually being provided. Large turbine aircraft are especially exposed here because owners frequently use management companies, charter affiliates, dry leases, interchange agreements, cost-sharing agreements, or fractional structures. Each of those can be commercially sensible. None of them is self-proving for tax purposes. Remember this, the tax law asks not who paid for the jet, but who sold the transportation. Under 29 U.S.C. Section 4261 imposes federal excise tax on amounts paid for taxable transportation by air. And the regulations emphasize that applicability is generally determined on a flight-by-flight basis. That single point explains a great deal of confusion in aircraft ownership. Parties often draft one elegant management agreement and then assume the tax answer follows the paper. But the excise tax analysis follows the transportation that was actually furnished and the amounts actually paid in connection with it. Congress created an important exception for certain aircraft management services, now reflected in Section 4261E, Paragraph 5, and the final regulations in Treasury Decision 9948. Those authorities confirm that certain amounts paid by an aircraft owner for aircraft management services, such as maintenance and operational support, may fall outside the air transportation excise tax when they are not payments for taxable transportation. That was a major development for private aviation markets. But the exception is not a permission to skip for casualty structuring. It does not convert taxable transportation into non-taxable management merely because the invoice uses management language. IRS materials on air transportation and audits still emphasize that one must determine flight by flight what service was provided and by whom. The NetJets litigation shows how real the issue is. In NetJets Aviation Inc. versus United States, the dispute centered on whether amounts collected in the fractional and management setting were subject to Section 4261. The public record in this case shows exactly why aircraft owners should take these rules seriously. Large operators, sophisticated contracts, and long-running programs can still end up in litigation whether the service sold was taxable transportation. Another important line of authority is executive jet aviation versus United States, where the Federal Circuit addressed taxation in the fractional aircraft context. You do not need to operate a fractional fleet to learn these lessons. The lesson is that once the structure starts looking like one party is furnishing air transportation for payment, the federal excise tax question becomes unavoidable. For large turbine owners, this frequently arises in 4 places. First, management company invoices that bundle flight services with support services. Second, related party leasing, where the lease exists on paper, but transportation is effectively being furnished as a service. Third, owner use of charter affiliates and repositioning arrangements where fees are not clearly characterized. And fourth, reimbursement models in which the parties understand the operation one way, but it is billed another way. That is why tax treatment, FAA structure, and operating reality must be aligned. A model that is non-commercial for FAA purposes does not automatically answer the IRS question, and a model that appears tax efficient on a spreadsheet may fail if the facts show that transportation was being sold. The practical strategy is straightforward, but it requires discipline. Map every revenue stream and every reimbursement stream. Separate true management fees from taxable transportation charges. Confirm who owns the aircraft, who used it on each flight. Confirm whether the flight is on the owner's own aircraft or someone else's. Reconcile the tax position to the operational documents, the dispatched records, and the invoices, and review the structure anytime the ownership, management, or charter relationships change. There is also a broader audit lesson here. In 2025, Form 4562 added a specific aircraft question for taxpayers claiming depreciation, requiring taxpayers to indicate whether they own, lease, or charter an aircraft. This is a small checkbox with a very large message behind it. The government is building cleaner visibility into who is taking aircraft deductions and under what model. So the final common IRS issue is not just one issue. It is the owner's failure to treat the aircraft as a tax system with multiple pressure points: depreciation, compensation, deduction, disallowance, and excise tax. Large turbine aircraft magnify each of those because the aircraft is expensive, the passenger profiles are sensitive, and the structures are rarely simple. Keep this in mind. I want people to remember the aircraft that creates the best tax result is usually not the aircraft with the most clever structure. It is the aircraft with the cleanest facts. Large turbine aircraft can be tax efficient, but only when ownership, operation, billing, payroll, and documentation are all telling the same story. That is what survives an exam. And that is what keeps an aggressive position from turning into a very expensive reconstruction project years later. In short, the common IRS issues in the tax treatment of large turbine aircraft arise because the aircraft sits at the intersection of business use, personal use, compensation, transportation, and proof. When those categories are blurred, the tax return becomes vulnerable, and the deductions as well. When managed deliberately, the aircraft becomes much easier to defend. Take this away. In large turbine aircraft planning, the winning strategy is not creative first. It is classification first. Thank you for your interest in this topic. This information is provided for informational purposes only and is not legal advice. Please direct any questions to admin@aviationlegalcounsel.com. We look forward to helping you navigate these issues with precision.